Paramount Skydance won the bidding war against Netflix. This has made many people very angry and has been widely regarded as a bad move. This is the story of how a company that had barely finished digesting one merger decided, and I cannot stress this enough, decided voluntarily of their own free will to take on $79 billion in debt to buy a media empire that nobody else wanted. And I mean that literally. Netflix specifically did not want all of it, but we'll get there when we get there. Let's go back to August 2025. Skydance closes its merger with Paramount. David Ellison, son of Larry Ellison, founder of Oracle, good ties with the CIA, a man whose net worth could theoretically backstop a small nation, takes the wheel as chairman and CEO. Now, Paramount walking in already has $14.5 billion in long-term debt. That is before anybody buys anything. That is just Tuesday. Moody's and S&P are already flagging a debt to EBITDA ratio of 4.3 times. For context, most media analysts get uncomfortable at around 3 times. At 4.3, you are not technically in distress, but you are the guy at the party who has had one too many and is very confidently explaining that he is totally fine. The plan, and this is a real plan that real finance professionals signed off on, was to deleverage to 2.4 times by 2027. 2 years to nearly cut their debt burden in half. Completely dependent on nothing going wrong, but otherwise was a simple and elegant solution. Then in December of 2025, Netflix shows up. Netflix, $77.2 billion in cash, roughly $10 billion in annual free cash flow, the undisputed king of streaming, decides it wants Warner Brothers Discovery. Specifically, it wants the good parts. HBO, the film studios, the prestige content, the stuff that actually makes the money. Netflix bids $72 billion for what it calls the studios and streaming assets. Not the whole company, remember this, just the parts with a pulse. Because Netflix looked at CNN and the Discovery Channel and the portfolio of mid-tier cable networks and said, very politely, no thank you, we're good, get the shit out of our faces. Comcast is also sniffing around, floating some kind of Universal Warner Studio merger. So anyway, you've got real competition, real money, real strategic vision on the field. And then David Ellison walks in. Ellison doesn't just bid, he outbids. He goes to $31 a share, a meaningful premium over Netflix's $27.75. And here's the move that wins him the deal. He offers to buy all of Warner Brothers Discovery, not just the good parts of Warner Brothers Discovery, all of the parts, everything, CNN, Discovery Channel, TLC, and I'm not talking about no scrubs. The entire graveyard of linear television that Netflix specifically refused to touch. Netflix did not want the dead weight, and Ellison said, I'll take it. And look, you can read that one of two ways. Either this is a bold strategic bet that the combined company's scale will let them wring value out of assets everybody else wrote off, or it's the move of a man who wanted to win the bidding war so badly that he agreed to take the thing the other bidder deliberately left on the table. On February 26, 2026, Netflix withdraws and Paramount wins. Here's what winning cost. It's like 5 Deshaun Watsons. The total enterprise value of the Warner Brothers Discovery acquisition is $111 billion. This is not a typo. $111 billion for a media company whose stock had lost roughly 2/3 of its value since the AT&T spinoff. A company that, under David Zaslav, had become famous for canceling finished shows, remember Catwoman everybody? Taking tax write-downs on completed movies and generally appearing to run a content business, a public business that you can buy shares of like a private equity liquidation. To finance this, Ellison's team raises $54 billion in new debt through Bank of America, Citigroup, and a syndicate of banks that will one day have to explain this decision to their shareholders. They assume $33 billion in existing Warner Brothers Discovery debts. They get $47 billion in equity from the Ellison family fortune. Let me get some of that, man. And Redbird Capital. And they pay Warner Bros. Discovery a $2.8 billion breakup fee to clear the Netflix deal off the table. They paid $2.8 billion to the company that they are already buying so that Netflix would go away. This is the entry ticket. So let's go do the math now, guys. Paramount brings in $14.5 billion in debt. They take on $54 billion in new financing. You're somewhere between $79 and $90 billion in total net debt, depending on how you count it and how charitable you're feeling. For scale, Netflix's entire market cap, the entire company, is around $400 billion. Paramount just leveraged up to roughly 20% of Netflix's total value in debt. Not equity, debt. I have to tell you this again. Netflix, by the way, as I said before, is sitting on $10 billion a year in free cash flow and has relatively low debt. These two companies are now competing in the same market. One of them can afford to make whatever content it wants, probably shitty content, but nonetheless, content. The other one is going to spend the next several years explaining to lenders why the interest payments are about to miss. On March 3rd, 2026, Fitch downgraded Paramount from BBB- to BB+. I want to translate that for anybody who doesn't live inside credit rating nomenclature. BBB- is the last rung of investment grade debt. It's not great, but it's respectable. Institutional investors, your BlackRocks, your pension funds, sovereign wealth funds, insurance companies, they can hold BBB- paper without anybody yelling at them. BB+ is the first rung of speculative grade debts. Junk. The moment you cross that line, a whole universe of institutional money is legally or structurally prohibited from holding your bonds. They fell off a cliff, even though they only went down one notch. The most consequential one notch in the entire bond rating system. And Moody's and S&P both put them on review for downgrade the day before. Fitch put every single Paramount rating on Rating Watch Negative, which is ratings agency speak for we're not done yet, probably. Of course, it's not just an embarrassing headline. This is a structural problem that compounds over time. Investment grade companies borrow cheap. Junk rated companies borrow expensive. This is the whole system. And the $54 billion bridge loan that Paramount raised to do this deal has no rate cap, which means that the lenders can charge whatever the market will bear at refinancing. If credit markets tighten, if spreads widen, if rates rise, if Fitch's Rating Watch Negative turns into another downgrade, the interest payments will go up with no ceiling. And Fitch was not subtle about what they expect. Free cash flows, they said, are expected to remain negative through all of fiscal 2026. Not break even, not even a small profit, straight negative. Meaning that the combined company in its first full year of operation is projected to spend more money than it takes in. So they borrowed up to $90 billion at an uncapped interest rate while projecting a negative free cash flow. There is a word for this in finance, several words actually, and most of them are not printable or sayable. Let's put the number on the absurdity. $79 billion in debt at a very generous blended interest rate, and, given the junk rating, 6% maybe optimistic, is about $4.7 billion a year just in interest before you make a single movie or run a single cable channel or pay a single employee. Ellison has pledged $6 billion in annual synergies. Cost cuts mostly, layoffs, consolidation, getting rid of redundant infrastructure. That sounds like it covers the interests until you remember that synergies don't materialize on day one. Year one, you are still paying integration costs, severance, transition expenses. The synergies are a 2027 or 2028 story. Maybe the interest bill starts now. Meanwhile, linear television, the asset that literally nobody else wanted, the thing Ellison agreed to take off the table for Netflix, continues its structural decline. Ad revenue for cable networks has been falling double digits annually for years. Fitch's language is worth quoting directly here because it is the kind of thing that credit analysts write when they're trying to be diplomatic about something catastrophic. They said that leverage and free cash flow may remain outside negative rating sensitivities longer than anticipated. This is a sentence that means we already modeled a bad system, but it could be even worse than the bad situation that we have already modeled. And of course, the deal isn't even closed yet, which adds a whole additional layer to this. The WBD acquisition has to clear regulatory review. You know, the SEC, I think? I don't know, the antitrust shit. That's 6 to 9 months, not 69 months, 6 to 9 months minimum with antitrust scrutiny across multiple jurisdictions. The EU, the US, basically everywhere. During that time, Paramount is on the clock. Literally. If the deal does not close by September 30th, 2026, Paramount owes Discovery a ticking fee of $650 million per quarter. Yes, per quarter. So the longer that regulators take, and regulators historically love taking their time with a $111 billion media merger, the more cash Paramount bleeds before the deal even closes. It's a reckoning of sorts. Before the first cost cut or the synergy or before the deal even closes. Okay, this is just for the privilege of waiting. And when that bridge loan needs to be refinanced into permanent debt, it goes to market at whichever junk-rated paper commands at the moment. There is no rate lock, there is no floor, it's just, here's $90 billion of exposure. Good luck, twin. God bless. The market, for all of its faults, occasionally does a reasonable job of pricing in reality. The day Fitch announced the junk downgrade, Paramount stock fell over 8%. Then another 6 to 7%, 6-7. In the days that followed as more details emerged about the debt structure. In under 2 weeks, you are looking at a 15% haircut, which on a company this size is not a rounding error. Institutional investors read the same Fitch report. That's kind of what they do. Barclays sold 88% of its Paramount position in Q4 2025 before the Warner Brothers deal even closed. KKR cut its position by 45% in the same quarter. These are not small retail traders panic selling on a bad headline. These are professional capital allocators who looked at this situation and said, we would like to own considerably less of this. Meanwhile, Netflix, the loser of the bidding war, remembered, announced $20 billion in new content spending and collected $2.8 billion in bank breakup fees. Losing has never felt so lucrative. So let's go do a quick shareholder tour because a deal this size, that's damage is diversified. My apologies. Stakeholder tour. Paramount is carrying $79 billion in junk-rated debt with negative free cash flow projections. David Zaslav, the CEO of Warner Brothers Discovery, sold $114 million of company stock right after the deal was announced, which is technically legal, but worth noting, he knew what he was selling. The employees at both companies are the collateral. $6 billion in annual cost savings does not materialize from renegotiating coffee vendor contracts. It comes from headcount, from shutting down the divisions, from the people who actually made the content and ran the channels, finding out that their job was a redundancy that needed to be optimized. The lenders, Bank of America, Citigroup, and the whole syndicate, the whole gang, are sitting on $54 billion in uncapped exposure to a junk-rated borrower in a structurally declining industry during a market with huge amounts of economic volatility. Bombs in Baghdad do that. Best of luck to their risk committees. And Netflix walked away with $2.8 billion, a clean balance sheet, and the knowledge that they never have to deal with CNN. They didn't win because they were the strongest bidder. They won, Paramount, because they were willing to take on liabilities that Netflix specifically refused to accept. They won because they agreed to absorb the dead weight that the rational buyer walked away from. They won by saying yes to everything the other guy said no to. That is not negotiation, that is Stockholm Syndrome. You're just getting the shit beat off of you in terms of liabilities, but he loves you, right? Anyway, sometimes the winner of the bidding war is not the one who got the asset, it's the one who made the other guy pay anything to get it. So guys, like, comment, subscribe on this video. Do what you gotta do, have a little sensibility. Or sensitivity, my bad, I was trying to reference Belle Biv DeVoe. Anyway guys, like, comment, subscribe. I'll see you guys next time. Peace out, thanks.